4 reasons your taxes will probably be higher in retirement, and some strategies you can implement now to keep them low. Let's talk about something that we've talked about before. A lot of people assume their taxes are going to be lower in retirement, but that, of course, is not always the case. So let's talk through those 4 reasons they may actually be higher. First, you don't want to compromise your quality of life in retirement. You have worked so hard for this, so you're going to be pulling in the same amount of income.
Yeah, or more. We want to live our best life, especially the first 10 years after retirement. We're the youngest, we're the healthiest,
right?
We're excited, we've just finished our work career, and we want to spend money. Now, when you say income, I agree. Income tax should be avoided in retirement. We should do everything in our planning process to limit the amount of money that's exposed to income tax, because the government gets to dictate what those income tax rates are. We don't. We prefer tax-free investing and tax-free money, or worst case scenario, taxable money, where you're paying capital gains, which are fixed rates of tax. And there's not much conversation about raising capital gains tax. It's more focused on the income side. So income tax is a no, tax-free is an absolute yes, and taxable money can be beneficial as well.
So the second reason tax rates are set to increase, many financial experts believe the Tax Cuts and Jobs Act of 2017 reduced federal income tax rates to the lowest that they may ever be, and those cuts are set to expire at the end of 2025.
That's right. And with $36 trillion in debt, something's got to give. Maybe it's tariffs, maybe it's Doge, who knows? But at this point, most likely, yes, we have to almost predict that tax rates will go up. Again, for our clients who are nearing retirement or in retirement, we're hoping that those higher levels don't escalate very high, but we have to be looking out for it because we don't want to get caught in a tax trap. So the time to plan is now while tax rates are low. You can do some Roth conversions, you can do backdoor Roths. Possibly you want to pay more taxes out of your paycheck to create taxable money, or contribute to a Roth 401k and pay the taxes up front. You know what the taxes are today, and everybody's talking about them being low. So while you're working, take the tax bite. Don't get caught in a tax wash when you're in your 70s or 80s, and I see it happening too many times.
Right. So the third reason for everybody at home, this is required minimum distributions. These are known as RMDs. Explain how these distributions affect our taxes.
Yeah, so they're based on an actuarial chart. So they basically want you to take out 100% of your pre-tax IRA or 401k in your lifetime. So what you need to understand is when you first are required to take that money out at age 73 now, that percentage is the lowest it will be for the rest of your life. So as we get older, we pay more. Doesn't seem very nice, doesn't seem very appropriate, but by the time you're 78, 79 years old, you're withdrawing 5% of your money out and you have to pay income tax on all of that. So those of you out there with an IRA pre-tax or 401k pre-tax of $1 million or more are stepping into a tax trap if you don't do tax planning in your last few years of retirement or your first, let's say, 5 years in retirement. That's the critical time to get a handle on it and make sure you're protecting yourself from getting overly taxed throughout the rest of your life.
Right. And you just said this, but it bears repeating. These Roth accounts don't have RMDs.
That's right. Pre-tax IRA money, we need to meet on it, we need to plan around it, and we need to avoid income tax in retirement.
Right. And you touched on this already, but again, this is so mind-blowing. U.S. debt now stands at $36 trillion. Who knows by the time people are watching this at home, it's probably going to be higher.
38.
Yeah. It gives me stress just to talk about it. But the government has 2 options to reduce that deficit. They either reduce spending, which how often do we see that? Not that often.
Not that much.
Or they have to raise taxes. So we have to plan for that.
That's right. And unfortunately, they most likely will have to do both. But what's the government better at? Being fiscally responsible or putting that burden on the American population? Yeah. So I would lean toward it's coming. Tax increases are going to be something we will face in our retirement life. Get ahead of them, prepare for them, and start to work with your 3 levels of money or 3 buckets of money. taxable investments, pre-tax investments, and tax-free. If you look at your portfolio and you say, I have 75% of it in pre-tax money, you have to do something about that.
Yeah.
You should have a third ultimately. Obviously, you'd want 100% in Roth, but that's not necessary because pre-tax investing and tax-deferred investing can be very beneficial. So I'm not against the 401ks that are pre-tax. It's just you have to balance the levels of the lake and make sure you've got different buckets to pull from at different times during your retirement life.
It must be hard to have that conversation with people who are such good savers and they come into the office and then recognize kind of what's staring them in their face with the tax deferred accounts.
Yeah, so I'll ask them, well, how much do you have in your 401k? And let's say the answer is $1 million. And
that's great.
But it's really only $700,000 because eventually the government's going to ask for their taxes to be paid. So it's a tough conversation to have, especially when, again, you've got 70 or 80% of your money that's never been taxed. You are a target, not an intentional target by the government, but you are a target for future income generation for the country. It's not the 20-year-olds that are making $60,000 or $80,000 a year where we're going to eat away at this $36 trillion in debt. It's the millions, if not billions of dollars that's in pre-tax 401k money that the government is saying, yes, we will eventually get paid. And then when they leave it to their children, if they do, we will get it all within 10 years. So we've got to plan around avoiding that tax trap.
Right, and so start planning now.
That's
Again,
right.
Applause to all our savers out there though, but the time to act is now.